The stock market rally hitting pause ahead of this week's Fed decision. JPMorgan's Monica Dicenso saying this: we need to acknowledge the strong start to the year, with the S&P 500 now only a few percent away from our year-end 2024 price target. This also argues for more selectivity and being thoughtful if you are still sitting on too much cash. We believe stocks will continue to make new highs. Monica joins us now in New York. Monica, good morning to you.
Morning.
We will make new highs in this equity market. Talk to me about how you put cash to work right now then.
The challenge has been everyone's waiting for certainty. You just talked about that. I don't think we're going to get it. The Fed is never going to tell us what the path is going to look like. And so the challenge becomes, then what do I do? Do I wait for certainty? Well, anyone who tried that the last couple of years has missed out on a massive rally. And so what we've been advocating to clients is just look at what we can see. Earnings inflecting, right? Put the Mag 7 aside. The other 493 earnings were down last year. We think they'll be up this year. You do have a modest inflationary environment, probably some cuts at some point. That is all good for stocks. Now, I don't think it means another 25% rally, but it is the path to saying maybe 5, 6, 7% from here, which is pretty good after we've already run 7%.
How would you play that? Is that an equal weight S&P 500? Is there a sector preference underpinning that in any way, shape or form?
I mean, the temptation is to say, we'll see the broadening. You got to go outside of the Magnificent Seven. I think it depends where you're starting from. Many people just don't have enough risk on full stop. So if you don't have enough equities full stop, you should be buying broad. If you are over levered to tech, then that's when I would start looking to things like mid cap, where you have valuations that are significantly lower than the S&P, and you have better earnings growth. And you have leverage to things like industrials.
I was looking at your notes, and it was amazing because there's sort of this clarion call from all different financial advisors saying, get out of your cash. Yeah. Why are you in so much cash? Rotate out. You're going to miss out. But you talk about keeping a buffer. What's the buffer?
It depends on what your goals are, right? Like I work with clients across the wealth spectrum, and so you have to just have a plan. I think that's the biggest challenge. Cash has felt good, but the problem is I've seen balances go 20, 30% plus of a portfolio. I think that's too much, really, whoever you are. And so it comes down to, what is my plan? If I'm trying to work towards a 10% buffer, you probably have some wood to chop, most people. I would also argue, you look at what the market's giving you. Volatility is still exceptionally low. So if you're really that scared about going into equities and risk assets, I would say dip a toe in and then buy a little protection. You're earning a lot on your cash, spend a little bit of that to buy some puts or something like that, just to keep you invested.